Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio, we have Michael Weisz. He is the CEO of Yieldstreet to discuss expanding investor access to alternative investments and where the opportunities are in the space. Michael, it's great to have you with us. Welcome to TradeTalks.
Jill, thank you for having me back.
You got it, and you recently took over the role as CEO at Yieldstreet. What are your plans for the company, and how are you expanding access to alternatives for investors?
Sure. So yes, since the founding of Yieldstreet, I've been co-founder and co-managing the business. And around July 4th, I had the opportunity to be the CEO. We felt that at this particular moment in time, where so many people are looking for access to alternative investments, it was the right time to transition to a singular leader. And so I'm excited now in this role to be focusing really on, one, enhancing the customer experience. We have a universe of over 450,000 customers that are constantly looking for access to a diversified portfolio of alternatives. And the second thing is to expand the way in which people can interact with Yieldstreet and the types of people that can interact.
Right. So how does the Yieldstreet model work, and how do you expect it to evolve?
So the Yieldstreet model, when we founded the business, we really were focusing on bringing private market investments to high net worth investors and accredited investors. And the way in which it worked at the beginning was simply that we would vet investment opportunities, and then folks would have an opportunity to come onto the website or to the Yieldstreet app and make that investment. What we've learned over time and what we continue to expand to as we grow the business is that we have to be obsessed with the customer experience. And so we have to continue to adopt how people invest in alternatives in a way in which makes the most sense for them. So for example, let's say you found an investment, whether it was in real estate or private equity or private credit, but you weren't sure how that fits within your broader portfolio. We don't want to be in the business of selling investments. We want to be helping you transition your portfolio away from 60-40 to have 30% in alternatives and deliver that holistic experience to you. So things like model portfolio, things like giving you different forms of advice, making sure that you can invest on Yieldstreet, whether it's do it yourself, guide me, where we can give you some direction, or do it for you, which you answer a series of questions and we can help create that portfolio for you.
So what's your take on the 60-40 portfolio then? What do you think is taking place at this point?
I think the 60-40 portfolio is dead and has been for a long time. I think the reason for that is actually fairly simple. The private markets have been so successful over the last 15 years. They're nearly $15 trillion. In a very simple way, what that means is that there's a lot of really well, high-performing institutional quality investments that never make it to the 60-40, i.e. the public markets in debt or in equity. And so we need to have exposure in our portfolios to the private market so that we could benefit from those investments that are never going to make it to the public market. And so I think what we're in the process of seeing on a much broader scale, we've seen it in the institutional world for a while. Institutions have recasted their portfolios to have north of 50% of their portfolio in private markets. We're seeing that happen on a retail level now, both from the advisor channel and direct to consumer. And so what people need to have in their portfolios is 40-30-30. We want to see 30% of your portfolios invested in private markets, high quality opportunities, real estate investments, private equity exposure, private credit exposure, et cetera.
So where do you see the best opportunities for investors within those spaces when you had mentioned private credit and so forth, or are there other areas you'd be looking at?
Listen, I think that where the best opportunities are and what investors are most looking for are two different things. Okay. I think where investor demand is today is focused on shorter duration cash flowing opportunities. You look back at January 2022, maybe one of the most bull times in the market that we could remember. Everybody was looking to buy a story, that next big private equity deal, that next big venture deal, that next story they could own. Today, they want more consistency in their portfolio. They want less correlation to broader markets. They want to get that cash flow. They want those payments, and they want the duration to be a little tighter. So in our business, what we were able to do is focus the investments team on across the asset classes: real estate debt, art debt, CLOs, private credit, litigation finance debt, fine art lending, et cetera. So giving people broad, diversified exposure in the private markets, but through debt or debt-like instruments.
Let's talk about the industry more broadly. Do you expect to see some consolidation in this space?
I do, absolutely. I think that if you look at the industry more broadly, and let's characterize that as any investment platform that is seeking to deliver investments online, okay? What has happened over the years is there's been about 20 or 30 platforms. Now, Yieldstreet separates itself in two major ways, okay? What we really have built at Yieldstreet is the most advanced distribution infrastructure, which allows us to live on the promise to our customers, which is helping you expand into a diversified portfolio. versus every other platform, which is a monoline business. They only service one asset class. And so if you're really trying to cater to the customer, you can't simply offer one investment, because then you're just selling them whatever's available to you versus going to find the best experience for them. The second pillar is a delightful experience. Investing needs to be and should be a place where it's trusted, where it's educational, where you could experience it in the way you want, where it's seamless, where it's ease of use. What has happened more broadly in the industry is it's highly fragmented across these monoline businesses. The problem for those businesses today are that with the market backdrop, many of them aren't as successful. So if you're a real estate equity business, or if you're in some type of asset class that is less favorable today than it was before, you need to contend with the fact that your business isn't as successful, but you have this large expense base to service your existing clients. What we are able to do at Yieldstreet, and why we believe there's ripe for consolidation, is because we built this distribution infrastructure. We can onboard investments, we can onboard investors, we can enhance the client experience, and also gain operating efficiencies because of the system and the capabilities we've built. So for all those reasons, I think that the customer has to win. So we have to be obsessed with the customer experience. They have to be able to invest in a diversified, holistic portfolio. And that's going to require some consolidation in the industry, because these companies aren't going to be able to service them.
All right, Michael, appreciate the insight. Thanks for joining us on Trade Talks.
Thank you.
And thanks for joining me. I'm Jill Malandrino, Global Market Reporter at Nasdaq.